Hello and welcome to this session. This is Farhat, in which we would look at fraud auditing, known as frauditing. Now, fraud auditing plays a crucial role in financial accounting and auditing. Why? Because to commit fraud, it means to commit financial fraud, it means you have to go through the books, the accounting system. Therefore, fraud auditing is important. The auditor will need to be familiar with fraud techniques. What are the red signs? What should we do if we happen to catch fraud? In this session, we're going to talk about introduction to fraud in general. Eventually, we would look at the auditor's responsibility when it comes to fraud. So the first thing we want to know is there is honest mistake. People make honest mistake, which are called errors, and we'll have to talk about the difference between that and intentional deception, which is fraud. So one of the key things that the auditor will have to differentiate between two is this an error or is this fraudulent activity? Why? Because whether it's an error or fraud, the auditor will have to take different route in addressing the issue. So it's very important to differentiate what do we have here? Is this an error or a fraud? So this session will break down the basics of fraud auditing, distinguish between errors and fraud, which is mistakes and fraud, look at some common types of fraud, and look at the motivation behind financial deception, financial fraud. So this is basically, as the title of this slide suggests, it's Introduction to Fraud Auditing. So it's an introduction to this topic. Let's go ahead and get started. We're going to have a series of recording covering this topic. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website. So the first thing is, what's the difference between an error or fraud? Well, the first thing about an error is unintentional. You did not mean to make this mistake. Think of it as a simple misunderstanding of instruction or a miscalculation. They are not done on purpose, and there's no attempt to cover them. And this is what makes an error really an error. The person that commit the error, if they're not aware of it, they don't attempt to cover the error. That's in contrast with what we're going to see later, fraud. This is an important distinction. Errors are easier to detect. Why? Because whoever commits an error, if they're not aware of it, they're not going to try to hide it. Therefore, the auditor will find it by error, by mistake, by seeing it laying on the ground. No one is trying to cover that. It's an error. There's no clock and dagger element, just a mistake waiting to be fixed. That's what an error is. On the flip side, fraud is intentional. It's done on purpose. Fraud include deliberate deception. Why? To gain some type of illegal or unfair advantage. So people committing fraud, okay, they try to hide it. And this is one of the main difference between errors or fraud, which makes it harder to the auditor to find. So fraud often include misrepresenting financial information or collaborating with others to cover their tracks. Remember, we're talking about financial fraud, and specifically we are discussing here, when we discuss this topic, from a public accounting perspective. Think of error, just kind of summarize it, accidentally paint spill on a canvas. That's fine. I mean, the paint spill. Fraud is an artistic, deliberate painting over flaws to fool the audience. This is what fraud is. You are misrepresenting. Now, what type of fraud could someone commit? We have to distinguish between two types of fraud that you need to be familiar with as an auditor: fraudulent financial reporting and asset misappropriation. So the first one is fraudulent financial reporting. As it implies, it's you are reporting the wrong figures, the wrong numbers. A case in point is the collapse of FTX. FTX is a Bitcoin central exchange. If you know this is Sam Bankman-Fried, known as SBF. What they did is they committed fraud. They financially reported their balance sheet at inflated figures. Eventually, when they were called to pay out, to pay the depositors, they did not have the funds, so they were fraudulently reporting their assets. This type of fraud aims to manipulate a company's financial statement. So you're trying to hide something that's not correct. You're trying to misrepresent the true financial picture. It's all about presenting a prettier picture to users, and this is what SPF was trying to do. Why? There are many reasons why. You are committing fraud, you don't have the money, you're trying to cover losses, you want to look good so your stock doesn't drop or your cryptocurrency does not drop. For one reason or another, you are trying to impress investors, management, regulators, whoever you're trying to hide it from, and whatever the reasons. Some ways this can be done through overstating income. This is one of the most common way when we talk about, again, public companies. Public companies are publicly traded companies, companies that are traded on the exchange. One of the most common ways is they overstate income. Now, how do you overstate income? You would either misrepresent your revenues, claiming more revenues or less expenses. But the point is to overstate income. Why income? Because if you overstate income, you overstate your earnings per share. If you overstate your earnings per share, your stock price will go up. Again, publicly traded companies. Understating income when it comes to private companies. So you have to be careful. If you're the auditor, if you are studying a company, what type of company am I dealing with? Is this a publicly traded company? What's the motivation? Or is this a private company? What's the motivation of a private company? Is to avoid taxes. They don't care about the shareholders because they're the shareholders. They're not trying to impress someone else. They want to save money. How do they save money? You understate income. So you have to be very careful of what's the motivation for the financial reporting. And earning management, deliberate manipulation to meet earnings target. Again, you could do earning management by overstating income. You could do earning management to understate income. You are managing the earnings to do what? To smooth things out. For what reason? Either avoid taxes or showing a prettier picture, a healthier picture for the company than you would. Many companies commit fraud over the years, whether it's Enron, WorldCom, FTX. Fraud gets committed all the time. Income smoothing, shifting income and expenses between period to even out financial results over time. Once again, going back to what? You do so to understate income or overstate income, depending on your motivation. If you want your company to look good, you might accelerate some revenues and defer some expenses. So show more revenues, less expenses now, shifting income and revenues. And the opposite is true. If you have enough income for this period, you met the expectation, you may defer, you may shift revenue to the next period. Why? Because you want to create that reserve early on to make sure you're meeting your earnings for the next accounting period. So this is some of the fraudulent reporting that you can carry on. Now keep in mind, how would you overstate income? Well, there's a lot of ways. Through account receivable, through unearned revenues. How would you understate income? Same thing. There are so many different ways. This is just an overview about what is a fraudulent financial reporting. The second type of fraud is misappropriation of asset, which is a fancy word for the word theft or stealing. But it's a fancy word for it. So it involves the theft of cash, supplies, inventory, or company assets. Simply put, you are stealing from the company. It's a theft. This often usually happen at a lower level within a company. Top executives are not immune, but when we talk about theft, we're talking about lower level, usually executives. They usually deal with fraudulent financial reporting. So SBF, Sam Bankman-Fried, he did both. He did financial reporting and misappropriation of asset. In other words, he actually literally stole the asset, the depositor's money, used the depositor's money for his own end, and he did what? Misrepresent the financial information. I do have a YouTube. You can take a look at it, The Collapse of FTX Accounting Perspective, so you can see exactly how he did it. Misappropriation of asset may seem small at first, but it can escalate into a major problem. Even a misappropriation of asset, although it could start, well, it's a small thing, maybe stealing inventory that could keep on going into cash, and from cash, that's the oxygen of the company, so it could lead into a major problem. Also, if a company did have misappropriation and it was uncovered, it's going to damage the company's reputation beyond the value of the cash. Because if you want to deal with a company, you want to make sure that this company can protect itself. If you're going to give your money to a bank and someone inside that bank stealing money, well, that's not good, because your risk is that's your money sitting in there. You don't want that. So that's why your reputation also will be damaged in case that happen. So that's why you want to make sure it goes beyond the scope of just the monetary immediate theft. It damages your reputation, and damaging reputation, it's very hard to repair a damaged reputation. Now, why do companies commit fraud? Why do people? So let's take a look at this multiple choice question from Farhat that's gonna deal with Introduction to Fraud Auditing. Which of the following is the most common in cases of fraudulent financial reporting? And again, we're dealing with public companies. What's the most common case of fraud? Is it overstating income, make an insufficient disclosure, overstating expenses and liabilities, understating income? Now let me tell you, here's the problem with auditing questions. They're all correct in the sense that overstating income is a form of fraudulent financial reporting. Make an insufficient disclosure is a form of fraudulent financial reporting. Overstating expenses and liabilities, it's a form of fraudulent financial reporting. Understating income, same thing. But which one is the most common case? So when companies commit fraud, and publicly traded companies, do they try to overstate expenses and liabilities? And the answer, publicly traded companies, generally speaking, no. So we can eliminate C. So C and D can have together, because if you are avoiding overstating expenses, it means you are avoiding understating income. D is out. Now we're between B, which is disclosure, not making enough disclosure, or overstating income. Well, if the company wants to commit fraud, they really would like to overstate, show more income, especially for publicly traded company. So that's why auditing questions are more challenging. They're more difficult because all four statements are correct, all four of them. So which one is the best answer is where you need to use your judgment. What should you do now? You want to go to Farhat Lectures, look at additional resources, multiple choice, true false lectures. That's going to help you whether you are an accounting student or a CPA candidate. The best investment you can make is investment in yourself. Study hard, good luck, and of course, stay safe.